Okay, so today we're going to look at the 2019 DEB Mock Question 1 Hill Ltd. You should all have your question in front of you, and I would advise you that you have a set layout. Now, what I have here is I've got my adjustments and steps, our working, our trading, our profit and loss, and our balance sheet. So the important ones here are trading, profit and loss, and balance sheet. It means that once we have the actual workings done out, we can place them into which account they go into, and when we start doing out the account itself, we can just pull the figures directly from there. You'll notice that all my final figures that we will be using are in red, so that I can easily pick them out as we're going along, and you can easily pick them out. Now, let's look at the first part of the adjustments. So stock on the 31st of 12th, 2018, we're dealing with closing stock here, was 91,200. This figure includes damaged stock, which cost 5,600 and can now be sold for €2,000. So this is nice and straightforward. However, before we actually go into this, we look through and see, is there anything else that may be involved here? And what I notice on part 9 is that no record has been made in the books for goods in transit. On the 31st of 12th, 2018, the invoice had been recorded as 18,450, which is including VAT of 23%. So let's have a look and see how we do each step here. So stock was 91,200. We had damaged stocks. We remove it. We've lost that value. So that's 5,600 less the 2,000, which is 3,600. And then we have to add goods in transit. Remember, they're going to be an asset to us. So we have to add them in. So that's our 18,450 divided by 123. And the reason we're dividing it by 123 is because that's the value including VAT, which is 123% of the actual value. And then, so after we divide it, we multiply it by 100 to get 100% of the value, and that equals 15,000. We add that back in, and our final figure for a closing stock will be 102,600. That goes into our trading account and also as a current asset in our balance sheet. So part 2, patents incorporating 4 months investment income are to be written off over a 5-year period commencing in 2018. Now, there's 2 parts to this. First of all, there's the patents, and second of all, investment income. Now, as you read through the question, part 10 and the first part of part 10 will say provision be made for investment income. So we're actually going to deal with all of it together here in our patents and get 2 birds with 1 stone. So patent and investment income, including from part, as you'll see in red there, X part 1, so 10 part 1. So we're starting with the patents from the trial balance, which are 30,500. It said that they're incorporating 4 months investment income, so we must find 4 months investment income and add it in. So in our trial balance, it says that it's 150,000 for investment income. It's at 3%, and we've been told it's 4 months. So by 4 divided by 12, and that will give us 1,500. We add it in, and we get 32,000. That 32,000 is going nowhere because we're told that there's parts written off. So we find out how much it is written off, and we remove it, so less written off over 5 years. 32,000 divided by 5 for 5 years gives us 6,400. That 6,400 is an administration expense in the profit and loss. Now, once we remove that, it gives us a figure of 25,600. And 25,600 is an intangible fixed asset in the balance sheet. And that is adjustment number 2 dealt with. You can mark it off. So we're going to then deal with the first part of adjustment 10, because we talked about investment income. And even if it doesn't mention in the question, which it should, if it's in the trial balance, you have to deal with investment income. So you'll be doing this anyway. So the investment income from the trial balance is 150,000. You'll notice that that is in red because that's a financial asset. However, our total investment that we're getting returned to us from the investment income is 150,000 by our 3% by 7 months. So by 7 divided by 12. And that's because it says that 3% investments on the 1st of the 6th. That means we have the full of June, July, August, September, October, November, and December, which is 7 months. And that gives us 2,625. and that 2,625 is an operating income or a gain or an other income, depending on what you call it yourself. Then we remove the amount that's been included in patents, because that's received, less amount included in patents, which is 1,500. And that gives us investment income due, which is a current asset in the balance sheet of 1,125. And that's another part of the adjustments now covered. So our next part is our part 3. And this is one of the parts that most students get confused on. So don't stress if you are. Just keep trying and trying and trying. Now, you can do it one of two ways. I've done it out in basic, straightforward, explaining each part. However, there is another way in T accounts, and if you would like them in that form, please just email me and I will send it over to you. The suspense figure arises as a result of the incorrect figure for debenture interest and a VAT payment of €2,500 entered on the incorrect side of the VAT or VAT account. Both transactions were recorded correctly in the bank account. So let's have a look. What does the suspense impact? First thing you do is look and see where is it included or incorporated in the trial balance. So it says that salaries and general expenses including suspense. So that's the first area it impacts. Second area, it mentioned straight away in the question, the incorrect figure for debenture interest. So it must impact on debenture interest. And the third is the 2,500 VAT payment. Now, we're going to start with debenture interest, then we'll do our VAT, and then we'll look at salaries and general expenses because we'll have to put figures into it. Okay, so our debenture interest in part 10 and part 1 of part 10, it says to provide for both investment income and debenture interest due. We're going to do that, the debenture interest now. We've already done the investment income, but we're going to do it now to get it out of the way. So the first thing is that 6% debenture interest in the trial balance, including €80,000 issued on 31st of the 3rd, 2018, was 280,000. Now, that 280,000 we're going to actually put into red, because that 280,000 is a long-term liability in our balance sheet. So the first 3 months in the trial balance, which are incorrect as we are told in our additional information, is stated as 3,600. Now we know that's wrong, so we have to find out what's right. So first things first, we got our 200,000, which we held for the full year. We only held 80,000 for 9 months of the year by 6%. So 200,000 by 6% gives us 12,000. The 80,000, which we had for the 9 months, we multiply that by 6% by 9 divided by 12 gives us 3,600. When we add them together, we will get a figure of 15,600. That 15,600 goes into our profit and loss beneath the operating income or the gains or the other income, and we remove it, so it's less debenture interest. And it's always the full figure. The next part is that we're told that the first 3 months are already paid, so we have to find out what 200,000 by 6% by 3 months divided by 12, so by 3 divided by 12 is, and this is going to be the correct figure of 3,000. We remove it from our 15,600 and we'll get a figure of 12,600, which is debenture interest due, and it's a current liability in our balance sheet. Now, we have to find a difference between the trial balance interest paid and our correct figure. So the first 3 months in trial balance was 3,600, less the figure that we have found, which is our 3,000, means that the interest error is less than what was stated in trial balance, and so it's added to the suspense, and it's €600 that will be added into our suspense. Now let's look at the second part here, and people get confused here. So the first thing we look at is VAT, asset or liability. So we look at EARL, EARL, expenses, assets, revenue and liability. So EA is debit side, RL is credit side. So our VAT in this case is on the credit side, so it's a liability. There's an error of 2,500, which is on the wrong side, So if we've put 2,500 into the wrong side, to balance this out and then put the right amount into the correct side, we must put 5,000 onto the debit side. So we put 2,500 into the credit side, we remove that, and then we remove that from the credit side, place it on the debit side, and we also put 2,500 to correct that error on the debit side, which means that we actually have 5,000 on the debit side. And this is on the debit side of our VAT account, so it must be on the credit side of our suspense account, so it means that we remove it from our suspense. So we go 15,000 less the 5,000 gives us 10,000. However, again, we come back to the goods in transit of part 9, which included VAT, which was 18,450 divided by this time 123, because that was 123%, and multiply by 23 to just find what the VAT was, which is 3,450, and we must remove that from our VAT as well, which means that we now have a current liability of 6,550 euro VAT. And again, now that just suspense the figures worked out. It's our VAT dealt with, so we've dealt with another account there, but now we must actually look and see what happens to actual suspense itself. So we're dealing with the salaries and general expenses because it's the one that's including suspense. In the trial balance, it's 245,700. We must add the debenture interest error because it was less than what was stated in the trial balance, which is 600 euro. So we add that in, we take away or less the VAT error, which is 5,000, and our final figure, however, more does happen later, but our final figure from this part is 241,300, and we'll see what happens later on with it. So we'll be keeping that in mind for later on. Now, let's have a look at our next part. So, a debtor who owed Hill Ltd 24,000 sent a cheque of 23,500 in full settlement. No entry was made in the books in respect of this transaction. Now, he owed, we'll take it that we're Hill. He owed us 24,000. We accepted 23,500 as full settlement. So we gave a discount of 500 euro. So the debtor owed 24,000, Hill accepted 23,500. It impacts on two accounts, the debtors and the discount account. So let's look straight out. We look at our debtors. So our debtors are 102,600 in the trial balance. We received 23,500, so we removed that. And we also gave a discount of 500, so we removed the 500. And that means that we have a debtors figure in our current assets of our balance sheet of 78,600. Now, the next part, as we stated, was the discount account. So, discount, again, we're looking at our EARL. So, it's either, we know discount's either an expense or a revenue, or another word for revenue here would be a gain, or an other income or operating income. So, it's on the credit side of the trial balance. So, it's 12,700 on the credit side, so it's a gain. We take away, we less the discount allowed, so we reduce that discount down by 500. And this isn't the final figure, because more happens later, but at the moment we've got a figure of 12,200 of a discount net, which is a discount received, so it's going to be a gain. And that's that dealt with. Now the next part has a number of things happening as well. So let's have a read of this and then we'll have a look at what's happening. So part 5, during the year, a storeroom which had cost 20,000 and stock which had cost 12,000 were destroyed by a fire. So we've got stock and storeroom destroyed by fire, basically. A new store was built by the firm's own workers. The cost of this labour of 28,000 had been treated as a business expense, and the materials costing 62,000 were taken from the firm's stock. The insurance company agreed to contribute 30,000 in compensation for the fire. No adjustment had been made in the books in respect to old stock, the old store, the stock destroyed, or the new store. So let's find out what's happening here. So it's a storeroom and stock destroyed by fire here. So what's impacted? First of all, our purchases. Because we've been told that there is materials taken from the firm stock. It's during the year, so it has to be taken from our purchases. Second is our salaries and general expenses, because we've used the firm's own workers for something that is not the business expense direct. Third is buildings. That one's quite obvious. If a store was destroyed and new one's built, it's going to affect the value of our buildings. And fourth is insurance compensation and a loss in the claim. We can tell straight away that there's a loss by the value by looking at it, and also there's compensation given to us, so we do get something. So we'll deal with these one by one. The first is purchases. The purchase figure in the trial balance was 1,460,000. We removed the stock destroyed by the fire, which was 12,000. We then removed the materials taken from the new store, which were 62,000, and these are all coming from part 5 of the information. Then I've actually went on and I've done our goods in transit. This has come in again. So nice and simple, from part 9, 18,450 divided by 123 multiplied by 100 means that we actually got €15,000 worth of goods into stock. So we have their purchases, so we add them in. And then we actually, if you read on to part 6, at the end of part 6, it says that the check of the net amount of this transaction was entered in the bank account but was incorrectly traded as purchase trading stock. And of course, this is talking about a new van which was purchased. So if a new van is purchased, and it's unusual to see this part come up, the storeroom previous to the new van, so before the new van. However, it has happened here, so we're going to deal with it now instead of coming back to it later. So a new van was purchased in part 6. Its value was 58,000. There was an allowance of 20,000 allowed on it, so we remove the figure that we paid, which was 38,000 from our purchases, and we'll get a final purchase figure of 1,363,000, and that goes into our trading account, and that is purchases dealt with completely. The reason I've done that now is so that you do not have to look back and see what figure did we have, what else do we need to alter. Get it out of the way as early as possible, and do that in as many as you can, as often as you can. It makes it easier. It means that it's not as messy, and it's also easier for an examiner to see, and they'll be more likely to give you more marks. So part 2 was our salaries and general expenses. So we're taking our figure from part 3, which we worked out at 241,300. All we have to do here is remove the labour for the new store, which is 28,000, and that will give us a figure of 213,300, and that's an administration expense in our profit and loss. Part 3 of this question, buildings. So buildings at cost in the trial balance were 1,250,000. We remove the destroyed store's value, which was 20,000. Then to find out the value of the new store, that's the labour and the materials added together and added into the buildings. So the labour and the materials are what give the value to the new store. So the labour of 28,000 we add in, and the materials of 62,000 we add in, and that'll give us a value, and this will be our balance sheet value. So our fixed asset in the balance sheet for buildings is 1,320,000. Now, we have now dealt with 3 parts out of the 4. And we've got final figures for all 3, which is nice because it's nice and straightforward now to put into our accounts. Now, our compensation of 30,000 is straightforward. It goes straight into our balance sheet and it goes in as a current asset, because we're going to get that. We've yet to be paid, so it's going to be an asset to us. However, there was a loss in the claim, so the compensation was 20,000. We removed the value of the store, which was, the compensation was 30,000. We removed the value of the store, which was 20,000, and we removed the value of stock, which means we actually lost out on €2,000. And that goes into our administration expenses. And that is that completely dealt with now. So you've got up to part 5 completely dealt with. So let's look at part 6. Part 6 says provide for depreciation on delivery vans an annual rate of 15% of cost from the date of purchase to the date of sale. Note, on the 31st of the 5th, 2018, a delivery van which had cost 44,000 on the 31st of the 8th, 2015 was traded in against a new van which cost 58,000. An allowance of 20,000 was given to the old van. The check for this, the net amount of this purchase, was treated as purchase of trading stock. Now, we've dealt with the check of the net amount, so we are only looking up to that part. So let's see what happens. So first of all, it's depreciation on the van and profit or loss on the van. So depreciation to date on the van sold is our 44,000 by 15% by 33 months divided. So it's by 33 months. So it's by 33 divided by 12. Now, where did I get 33 from? If we look, it says that it was on the 31st of the 5th, 2018, a van which was purchased on the 31st of the 8th, 2015. So we went from 31st of the 5th, 2018, and it was purchased on the 31st of the 8th, 2015. So we have 2016 and 2017, which are 2 full years. So that's 24 months. In 2015, when we purchased the van, we had September, October, November, and December, which are 4 months. So that brings us up to 28 months. And we got told that it was sold on 31st of the 5th, 2018. So that's 5 full months for 2018. When we add that together, we get 33 months. So 44,000 by 15% multiplied by 33 divided by 12, and that gives us 18,150. But we're not going to put that anywhere. We're going to use it in step 2. Step 2 is the profit or loss on the sale of the vehicle, or the van in this case. We need to find the net book value. So the original cost was 44,000. We remove the depreciation of 18,150, and we'll get 25,850, which is our net book value. So our next part is our allowance less our net book value gives us a profit or loss. Our allowance in this case is 20,000. Remove the 25,850, and we get a 5,850 euro of a loss. So that's a selling and distribution expense in our profit and loss. Step 3. Cost of vans for the balance sheet. The cost of the vans for the balance sheet is the cost in the trial balance less the cost of the van sold plus the cost of the new van. So we get 310,000 from the trial balance. We removed the van that we sold, which was valued originally at 44,000, and we add in the van that we've now purchased of 58,000, and we'll get a figure of 324,000, which is a fixed asset in our balance sheet. Now, let's go on to step 4, the depreciation for the current year. So we get the old van depreciation, the new van depreciation, and then the vans that we actually held for the full year, which is the cost of the total cost from the trial balance less the old van, and that's the vans that we held for the full year. So the old van is 44,000 by 15%. We sold it on 31st of May, so by 5 divided by 12 gives us 2,750. The new van is the 58,000 by 15%. We had it for the rest of the year, so we had it for 7 months, so by 7 divided by 12 gives us 5,075. If we get 310,000 and remove 44,000 from it, we get 266,000. So we held that then for the full year. Multiply it by 15%, and that's 39,900. So our depreciation for the current year is 725, and that is a selling and distribution expense. And step 5, our depreciation for the balance sheet. We have to get our accumulated depreciation, our opening accumulated depreciation. So that's 310,000, which is our cost in the trial balance, less the net book value of the trial balance, which is 220,000, gives us 90,000, less the depreciation on the van sold, which was 18,150, but it's gone, and add this year's depreciation, which was 47,725, and that will give us 119,575, which is the depreciation in the balance sheet in our fixed assets. And as you will see, that is us done that adjustment. So now to move on to adjustment number 7. And as you'll see, these will start getting quicker as we go on. The first few are the longer ones, and then we'll get quicker from here on in. The figure for advertising is for a 24-month campaign, which began on the 1st of the 6th, 2018. So it began on the 1st of the 6th, 2018. So that's June, July, August, September, October, November, December. That's 7 months. Be careful. It's 7 months, not 6, 7. So what we're looking at here is the advertising figure in the trial balance is 48,000. Let this year's, which started on the 1st of the 6th, 2018, 48,000 multiplied by 7 divided by 24. Remember, it's a 2-year campaign, so it's 24. Gives us 14,000, and that 14,000 is a selling and distribution expense. We remove that from the 48,000 to get advertising prepaid of 34,000. So that's a current asset in the balance sheet. So that advertising prepaid is a current asset in the balance sheet. So we've now dealt with the advertising, which is adjustment 7, which is very straightforward once you see it. Again, if you have any questions up to this far, please feel free to email me, state what the issue is, and I'll go through it individually with you. Okay, so our next adjustment, and this has a few parts to it. Again, once we read through, we'll see what we're dealing with, and we'll go from there. So a creditor who was owed €12,800 accepted office equipment with a book value of €11,600 in full settlement of the debt. So straight away here, there's a discount. He was owed 12,000. The value of the equipment was only 11,600. So there's a discount. The office equipment cost 16,000. So now we're dealing with a depreciation value because it cost 16,000. It's now worth 11,600. So there's going to be depreciation. No transaction had been made, and provide for depreciation on all office equipment, this is saying, held on the 31st of 12th, 2018. So that's on any equipment that's left on the 31st of 12th, 2018 at 20% of cost. So let's see what we're dealing with. So first, I've said here, creditor was owed 12,800, accepted office equipment with a net book value of 11,600 as full payment. Equipment cost 16,000, so that means there's depreciation. So what's impacted? 1, creditors, 2, discount, and 3, office equipment and the depreciation of office equipment. So let's have a look at the first part. The creditors in the trial balance was 87,500. We now remove the value of the office equipment, the net book value, which was 11,600. We've given that to them. However, they've given us a discount, so we removed the discount of 1,200, because that's 12,800 less 11,600, which is 1,200. Because that debt is fully paid, so we remove it completely out of the creditors. And we add the goods in transit. Again, I'm coming back to number 9, goods in transit. We've used it for stock, we've used it for purchases, and now we are using it for creditors. So now it's dealt with completely. And it's the full value of 18,450, because that's the full value that we are paying those creditors. So we add it in. So that figure in our balance sheet as a current liability for creditors is 93,150. Let's look at part 2. From a discount, and we take the figure from part 4 above of 12,200. I did state when we did it, it wasn't complete. We add the discount received. So we've received discount. Remember, what we've noticed from this discount is that it is going to be a gain. So 12,200 add the discount received means that we've received a discount overall of 13,400, and that goes into your gains or your operating income or your other income, whatever you call it, or you decide to call it, in your profit and loss. And then part 3. Now, there's a number of factors happening here, but we'll start with the office equipment value for the balance sheet. So the office equipment cost in the trial balance was 45,000. We have now given away office equipment that had a net book value of 11,600. However, the cost of the equipment was 16,000. So it means that our office equipment value in the balance sheet is 29,000, and that's a fixed asset. Now we have to find depreciation on this and the office equipment overall for the profit and loss. So the office equipment for the profit and loss is the cost less equipment given to the creditor, which is 29,000, by 20%, which is 5,800, and that's an administration expense in the profit and loss. Now, the depreciation for the balance sheet. This is where it's important about the office equipment that we gave to the creditor. So We get the cumulative depreciation up to the current year, which if we look in our trial balance, it cost 45,000, less the net book value in trial balance was 35,000, it gives us 10,000. Now we remove the depreciation on the equipment given to the creditor, which is 16,000, less 11,600, which is 4,400. And we add this year's depreciation, which is 5,800. And that gives us a total depreciation figure in the balance sheet on the office equipment in our fixed assets of 11,400. And that there is our office equipment dealt with. So again, that's number 8 dealt with completely. We've already dealt with number 9 because we know that we've done our goods in transit. So if we look here, goods in transit, number 9, who or what does impact our closing stock? Already dealt with, our purchases already dealt with, and our creditors already dealt with. So let's look at number 10. Now, the directors recommend that 1, provision be made for both investment income due and debenture interest, which we've dealt with. Number 2, provision for bad debts be adjusted to 5% of debtors. So this is very straightforward. The provision for bad debts is from the part 4 above. The debtors figure is from part 4, so 78,600. We get 5% of that figure, which is 3,930, and you remove that from debtors in the fixed assets section of your balance sheet. Now, we already had a trial balance figure for provision for bad debt of 5,200. We removed a new figure, and since this has actually decreased now by 1,270, so our provision for bad debt we thought was going to be 5,200, it's actually only 3,930. It means that we've got a gain or an operating income of 1,270 in our profit and loss. And then part 3 states the buildings to be depreciated by 2% of cost. This is straightforward. You get your figure from part 5 above, which is 1,320,000. You have to find 2% of it. So depreciation for the profit and loss is 26,400. So 2% of 1,320,000 is 26,400. Now what we must do is find the depreciation for the balance sheet. So we get the cumulative depreciation from the trial balance of 1,250,000, which was the cost, less the net book value of 1,100,000 is 150,000, and this year's depreciation gives us 176,400, and that is our depreciation in our balance sheet in our fixed assets for buildings. And now the final part of this question. The managing director should be paid a bonus of 2.5% commission on all sales in excess of 1,250,000, and then an additional or further, so 4% in excess of all sales above 1.5 million. So first thing, 2.5% on sales over 1,250,000. So that's 1,880,000 less 1,250,000 gives us 630,000 by 2.5% is 15,750. Then we've got 4% extra on sales over 1,500,000. So 1,880,000 less 1,500,000 gives us 380,000 by 4%, which is 15,200. We add them both together, 30,950. That is a selling and distribution expense in our profit and loss, and also a current liability in our balance sheet. And that is that account adjustments complete. If you flick on to page 2 of this, you will see each of them entered in to our accounts themselves. I'm not going to go through that in detail. Again, if you have any questions, please ask by emailing me. So that is all of our accounts completely finished. Again, any questions, just email me.